Unless you were somehow very lucky, none of us learned about money when we were young. The best we got, at least from my perspective, was, oh, you should probably try and save some of the money that you get from the tooth fairy and put it away for a rainy day. I had no idea about investing, no idea how to budget, and no idea how money worked. We've all still got loads to learn, but for the time being, I wanted to share with you 8 lessons that will change the way you think about money forever. Getting right into these, it's not what you earn, it's what you save that makes the difference. From my own experience, I know this lesson very well, and before YouTube, I spent a decade in IT sales.
How about computers? Do you like computers?
I've earned a salary in every tax bracket through the years, from a basic rate taxpayer to way over the additional rate of tax, where I've ended up even owing the taxman even more money. And while that sounds great, earning loads of money, unless you save or invest any, you end up in exactly the same position as someone else making way less than you who just spends less.
I've got nothing left.
It's probably the easiest trap to fall into as well, because as soon as you make some money, of course you want to spend it. You've worked hard, so you deserve to treat yourself. The issue you then get is upgrading your lifestyle to tell the world just how great you are ends up costing you everything you have, and all you end up with is loads of expensive stuff which loses you more and more money.
Armani. Expensive.
And yours?
Sergio Giorgini.
There's so many real-world examples of this, and this reminds me of the book The Millionaire Next Door, where the authors surveyed hundreds of millionaires in the US back in the late 1990s. When surveyed about their shopping habits, the millionaires were asked how much they'd spend on different items like suits, shoes, and watches. You'd definitely expect that millionaires would be the ones buying the more expensive stuff as they had more money, right? But the truth is actually quite interesting. Here's the numbers on this table which they actually spent. Across suits, 50% or more never spent more than $399. On shoes, not more than $140. And on watches, which people seem to obsess about here on YouTube, $245 was the average. Only 10% of the millionaires asked spent more than $3,800 on a watch. So the question is, who's buying all the expensive suits, shoes and clothes? The answer? People who don't have the income of a millionaire or the wealth, but think they have to show everyone else how rich they are. I'm all for enjoying your money, and believe me when I say I've spent my fair share on stupid stuff, but take the lesson that if you want to be properly rich, you're going to have to spend like someone who makes a lot less. Okay, lesson number 2, the value of money is tied to time. This is the lesson where we realize that the money in our pocket doesn't always have a fixed value, and it's always changing. Let's say that we took the advice from earlier and saved that money from the tooth fairy, and once we lost all of our teeth, we had £10 or $10. It really doesn't matter. As you'll all know, that £10 from many years ago won't buy you anywhere near as many sweets as it would now. And forgetting about sweets, this applies to everything. On the Bank of England's website, there's even a trusty inflation calculator that we can use to show us how the value of money has changed over time. Let me show you a quick example and see what my £10 from 1990 will need to be in order to have the same buying power today. And we get to £23.07. So in other words, your money has lost more than half of its buying power if you don't do anything with it. And that's just in over 30 years. Right now in the UK and many parts of the world, you'll know that inflation's been running out of control to the extent that we're seeing prices go up more than 10 or even 20% on certain items. So unless you're earning more money, you're losing out, and effectively your salary, or what you're taking home, is actually affording you less and less stuff. Not a good place to be in, especially if it continues for a long time. Now, the big question is, what can you do about this now that you know about it? Well, this leads us perfectly on to point number 3. To be truly rich, you need to have your money working for you and not working for your money, or at least not only working for money. So, as we just learned from the last lesson, inflation is our enemy and we need to beat it over the long term if we want to build any kind of wealth for our future. And the only real way to do this is to make sure that we invest our money into something that can increase in value over time. So basically, we need to invest in assets. We've got to take that money that we've earned, invest it into assets, and over the long run, those assets should grow more and more to the point where they can even generate us more money than we can even make while we're working. Pretty much the definition of a true passive income, if you want to put it like that. Now, assets can be anything like real estate, stocks and shares, bonds, commodities, you name it. Just anything that, over the long term at least, has beaten inflation and helped to grow wealth. Here's a good example. Let's take the S&P 500, which is pretty much most of the entire value of the US stock market, and see how well it's done over the past century. So that's 100 years worth of data. With inflation taking into account, $100 invested in 1923 would be worth today in 2023 $109,000. The average return per year was 10.36% per year, or when taking inflation into account, you still made 7.23% a year. Now, just for fun, without taking inflation into account, you'd actually make $1.9 million. But sadly, you can't escape inflation as easy as that. You have to invest your money, otherwise it's guaranteed to lose value over time. Now, I've got loads of videos on my channel to help beginners get started investing, and I've also shared some links below for offers from investing platforms that I use where you can get some free money once you open up your account. So go ahead and check these out in the description if you want to get started. Lesson 4 also leads nicely on from this one. If you're going to invest or really take this whole wealth building thing seriously, then the weird thing is you shouldn't do it for the money. Sounds like such a crazy thing to say, but there's a bit more we need to say here really. So obviously having more money will give you a lot more freedom and allow you to make better decisions without the lack of it getting in the way. But unfortunately, more money won't address other major issues like your happiness or your self-worth. Unless you have some kind of goal or aim, building wealth or making money, in my opinion at least, just for the sake of it, is kind of like going to the gym because you want to get fit. You might start off well to begin with and commit to doing it 3 to 4 times a week, but then when times get tough and it's really cold outside or you feel a bit tired, you stop going and you just give up.
Cold outside, Polly.
It's the same with investing when the market takes a downturn. I've told this story before, but there was a Wall Street trader by the name of Jesse Livermore who, back in the Great Depression towards the end of 1920s, made a fortune of $100 million, which in today's money would be worth more than $1.5 billion. Now, while everyone else was suffering from their stocks losing value, Jesse had bet against the market and made himself a fortune, putting himself up there with some of the richest people in the world. So, did he retire happy and spend the rest of his life enjoying his wealth, never to bother taking big risks again? No. He ended up losing it all, taking bigger and bigger risks, assumed that he knew it all, and never found an amount of money that was enough. There are so many examples out there of people just like this, so just before you start investing your own money, at least give it some thought as to why you're doing it. Don't do it just for the money.
What would it take? I mean, what would it take for you to feel secure? More.
Speaking of money, let's head to our next point, which is a reminder that real wealth takes a very long time to build. Some of you might already know this, but Warren Buffett, widely held as the greatest investor of all time, built most of his fortune after his 65th birthday. In fact, he amassed 90% of it after this time, and it's all down to the magic of compound interest and the lovely dividend snowball effect. He definitely was never poor, let's not pretend he was struggling with just a few billion, but the point was that all of this money doesn't just grow on trees, and it takes a long time to make it grow. Just as an example, let's say the moment you're born, someone puts £5,000 into an investing account and says, you can't touch this until you're 65, this is all for your retirement. With that much money in the stock market, assuming it's just invested in a boring old index fund and gets 7% a year on average after inflation, which is the long-term average as we just saw before, you end up with, wait for it, £466,948. Now, just a thought, but why doesn't the government do that every time a child's born, lock away money in a fund for their retirement so we never have to spend taxpayers' money today for Social Security? I'm sure that's come up before as an idea and not an original thought at all, but hey, wouldn't that be nice? Anyway, the lesson here is that unless you win the Euro Millions or somehow have inherited a huge amount of cash, investing and making money will take a long time, and this truly is a marathon, not a sprint, but there will always be people out there claiming to get you rich quick or promising the world with the latest hot stock or crypto. There are tons of grifters here on YouTube who do exactly this. Hide their losses, show off their gains, and forget to mention that all of the money they've put into their accounts is really what helps their investments grow. Lesson 6, and one that I learned way too late in my investing journey, find out about your tax-free or tax-advantaged investing accounts. When I started investing, in hindsight, I was trading and messing around buying all kinds of stuff, and I had no idea what Stocks and Shares ISA was or any kind of account for that matter. I thought it was some kind of account where I had to lock my money away or something like that. Knowing the types of investing accounts and how they benefit you and the rules around them, I think are absolutely essential if you want to be a good investor. Again, nobody learns this stuff at school or early on in life, and it's almost criminal how the majority of people couldn't tell you much about what accounts are available to them. So my lesson here would be to go and find out about them. I've got a ton of videos on my channel and a dedicated playlist for investing for beginners especially. I mean, just think, going back to my point earlier, let's say that you did use an account like a Stocks and Shares ISA here in the UK and deposited that £5,000 and left it invested in the stock market for 65 years. That's nearly £500,000 you'd end up with, and it's completely tax-free. There's no income tax to pay on it, no capital gains tax, and you never had to pay a penny on dividends too. You can take as much out or as little as you need, and there's no limit to what it could grow to if you invest in the right kinds of things. Up next, this sounds easy and sounds really basic, but I think we can all relate to it in one way or another. Avoid debt as much as possible and be really careful with it. This was an important lesson for me, as like a lot of people, during university, I ended up with loads of debt across overdrafts, credit cards, and all sorts of other rubbish. So when I started working full time, most of what I made ended up just paying for the debt. and I barely got above my overdraft every month before slowly falling back into it. Credit card debt slowly got worse as well, because after those lovely offers ran out, like a 0% balance transfer or that 0% purchase for 12 months, the interest really kicks in after that, and all I was paying for was the minimum amount, which is probably one of the worst things that you can do. It's really tough on you mentally, and it's an absolute cash cow for the credit card companies and banks who make a huge amount of interest because you got attracted to those initial offers, forgetting that it's all money that does actually need to be paid off. Now, I'd never say avoid all debt, that's just extreme. Obviously a mortgage is very different, or even a low interest loan maybe for your car too. That's kind of in a different category, but credit cards and other loans on rates like 10, 15, or even more than 20% just have to get paid off in my view, and you'll feel so much better once they're off your back. Paying off a 20% interest credit card is the same as making 20% in the stock market with your investments, except it's guaranteed, whereas in the stock market is a risk, especially in the short term. So I know it sounds basic and I know it sounds simple, but if you can get this done, you'll feel loads better and you can then start worrying about things which are actually more important in life. Oh, and don't forget to work together with your other half or your partner. Sharing is caring. And finally, maybe a lesson that we're all still learning, but money isn't everything. If you've ever bought something that you've wanted for a really long time, isn't the excitement of having it nowhere near as ever exciting as all of the weeks that you spent looking at it online? Or how about finally reaching a goal in your investing account? You've finally hit 10k, 50k, or even 100k. The truth is, I'm learning more and more that it's not about the money, but more about what you choose to spend the money on. I feel that sometimes we get caught up in the race of just trying to have more and more money, and I see this across lots of the finance YouTube community, especially in the US. But doesn't this completely miss the point? I read a book recently called Die with Zero by Bill Perkins. I've actually lent it out right now to a friend. As you might guess by the title, the book deals with those questions. Why have loads of money invested or a massive portfolio saving up for a time when you might not even be able to enjoy it, let alone walk and run around as easy as you could do now? Be sensible, yes. Invest your money, yes. Save your money, yes. But don't forget why you're doing it and find those things along the way that make life worth living to spend that money on. After all, you can't take it with you. Go read the book if you want more details. It's well worth the read. On that note around investing for the money, this is a video I did a while back talking about this very topic. You might like it, go and check it out next. Thanks so much for watching. Leave a like on the way out, subscribe for more, and as always, happy investing.